Hello investors and traders, and welcome to the weekly market report with the market guys. I'm AJ Monty. This is the most current daily candle chart for the Dow Jones Industrial Average ETF, ticker symbol DIA. And as you may have seen in the past, I leave my lines up on the chart from the previous week so you can see exactly how the market has played out over the course of the week. And this bottom line right here was the support level that I identified as a role reversal support here, expecting that the market would move down towards that line and then bounce from it. So here is the forecast. I said it would move up to fill the gap, which it did. Now we're at a point where we're very close to the 200 period moving average. Again, not that very far away here, and I expect that the price will start to drop next week as the moving average fails to recover. So that is the most significant signal that we've seen was the bounce, and you can see from the volume here that the volume has been dropping after this little bounce, which tells us the volume was 50% of what it was on the candle here 2 days ago, and that's an up candle on lower volume. That's bearish. Once a gap fills, there's a very strong chance that the market will drop from this point, which is what we expect here, like I said last week. And you need to be very protective. Don't buy into this market with any kind of enthusiasm at this point. Now, if we look at the Qs, this is the NASDAQ market, you'll see that, again, I've left my lines. I did say we would pull back to the fan line here, which we did, and then bounce, which we did. And now, with this very small candle, close to the 200 period moving average, I am expecting the market to fail and drop below this fan line. So to adjust this, I can actually get rid of this drawing here and readjust those lines so you can see what we're expecting for next week. And again, follow along. This is not rocket science here. It's simply looking at the charts and forecasting. So what I think is going to happen is we are going to now pull back from this point to break down below this fan line in an attempt to retest the third fan line and then possibly bounce from there. So I'm going to leave that on there so you can see as the 50 period moving average, this blue line, as that moving average starts to roll over, the extreme downward move we've had this week is going to pull that moving average even closer, and I think we can wind up with a death cross like we saw in the Russell 2000. Let's go to that Russell 2000 daily chart, and you can see there's the death cross that resulted in a downward move. Now let's talk about the Russell 2000. I drew this as a role reversal resistance, expecting the market to pull back to that point. It did within pennies. It's just a small little sliver of a difference there between this line and the high from today. Now what I expect is this market will start to pull back and move back down as the moving averages roll over to the downside. Now if we look at the weekly chart on the Russell 2000, remember this is a more broad-based index than the Dow is. Don't pay too much attention to the Dow because it's only 30 stocks there. You look at a weekly chart of the Russell 2000 and we still have a breakdown of a head and shoulders pattern up here with this lower line right there being the neckline that was violated. So this projection, the short-term projection that I drew here, is a very realistic and reasonable path that we expect the market to follow, and therefore you need to be very, very cautious of any long positions. We are now starting to move into short positions overall through our trade alerts and buying bear ETFs or contra funds or anything that's going to move up when the market goes down. Now let's look at the spiders. This is ticker symbol SPY. This was the 7-year cycle line that we found from the monthly chart. You can see every 7 years so far we've been experiencing a tremendous downward move. I do expect that this will follow on the 7-year cycle path. If we zoom into a daily chart, you're going to see that we have a little spinning top here below the 200 period moving average on lower volume. That means there's a good chance that the market is going to pull back from here and go lower next week or even the week after that. We'll follow that step by step as we progress. I'm going to leave this line up there for you as well. Now let's look at the VIX. The volatility index is a strong measure of emotional premium that will tell us what is going through the minds of the investors. We had a big spike, and I drew this horizontal line as the resistance line for the VIX. Isn't that interesting? Remember, this is contrarian to the S&P. So the VIX hit that line and then formed a very long red candle and then dropped. Now remember, this VIX will go up when the market drops. Now that the VIX has dropped and there's a gap above the market, a spinning top here at a new role reversal support would most likely result in the VIX moving back up. Which, again, what does that mean for the S&P? If the VIX is moving up, that's bearish for the S&P. So, all the signals right now are pointing for a second wave lower as we await the next week of trading activity. This is not a time to be getting aggressive. I would not even think about taking any long positions right now with the way the VIX is, because if you look at a weekly chart of the VIX, you can see this extreme move. This is what we looked at back here as well, but we're violating this in a big way. And if you look at the monthly chart and you go back to what happened in 2007, look what happened in 2007. We had a very strong move on the VIX, which was even higher than what we have this week. This particular high VIX resulted in the beginning of what was one of the most incredible sell-offs in 2008 that resulted in much higher volatility levels. So we are forming this pattern that we did back here in 2007. You need to be very mindful of that so that you don't get caught up in the bull trap. There are bull traps out there. It's the general managers that are trying to get you, the investor, to pump into their mutual funds. Don't buy into that. Be defensive. Cash is actually a position, and that is something that's a safe haven right now, at least while interest rates are low. You're protecting yourself. As interest rates go higher, there's other things we can do with our cash. But for now, be protective. Put your stops in, move to cash, maybe even play some short positions, and stay in tune with the market, guys. So have a great weekend. We'll talk to you soon. Bye-bye.